So in our last lecture, we talked about the two funds, right? The capital project fund and the debt service fund. And we continue with the topic. Let's talk about how we record capital assets and the long-term liabilities. First, let's talk about the general capital assets. What are general capital assets? They are associated with the government as a whole, rather than with any specific fund. So, we're not going to talk about the assets associated with proprietary and fiduciary fund. And they're not financial in character. They will be excluded from the governmental funds because of the measurement focus. Remember, we're talking about measurement focus. We only focus on current resources. So the general capital assets will be excluded from governmental funds. The definition of capital assets varies, okay? And different government agencies will have different definitions. For example, the City of Austin defines capital assets as assets with initial individual cost $1,000 or more, and their estimated useful life greater than 1 year. The City of Houston, however, defines capital assets with a cost of more than $5,000, okay? Much higher, and estimated useful life in excess of 4 years. So same capital assets in Austin could be recorded as non-capital assets in Houston. The definition will be different. Accounting for general capital assets. In a government-wide statement, because we adopt a full accrual basis, right, general capital assets will be capitalized in the governmental activity columns and will be depreciated. In the final statement, we're going to debit the full cost to expenditures in the appropriate governmental fund. Okay, depends on which fund we use to record those expenditures when the assets are acquired. So let's talk about accounting for general capital assets, for purchase assets. So if we capitalize assets in the government-wide statement, this is how much we're going to capitalize. Generally, they're going to follow the financial accounting. So for example, we're going to capitalize cost, right? That cost include purchase price plus transportation plus installation cost, right? Any cost that can bring this asset into intended use will be capitalized. And if we construct, right, we can capitalize direct labors, overhead, architect fees, and insurance premiums. But unlike financial accounting, okay, no, we cannot capitalize interest on constructed assets. This is different from the financial accounting for business activities. Okay, no capitalized interest. right? But if we record all these activities in governmental funds, okay, all these will become expenditures. Okay, there's no capitalized asset or are expenditures. And if we have trading, if we acquire assets from trading, assets will be recorded at the fair market value. And if we receive donated assets, right, it will be reported at the estimated acquisition value, which is also a fair value. Right, if we purchase this asset, right, how much we need to pay for it. Then let's talk about the collectibles, which is a very unique asset. For example, the museum, right? They're going to have a lot of collectibles. So how do we record the collectibles under GASB? Collectibles are not required to be capitalized as long as the following conditions are met. Okay, let's see, what are those conditions? They're held for public exhibition, education, or research in furtherance of public service, rather than for financial gain. For example, for museum, okay, collectibles are for public exhibition. Next, they are protected, kept unencumbered, cared for, and preserved. Okay, I think most collectibles will satisfy this criteria. And finally, they are subject to an organizational policy that requires the proceeds from sale of the collection items to be used to acquire other items for collections. Right. So the museum may sell those collectibles, but they have to use the proceeds to purchase other items for collections. Right? We satisfy all these criteria, then the collectibles, okay, will not be capitalized. So if they're not capitalized, if you read in museums statement, okay, we are not going to see collectibles in their either funds statement or government-wide statement, because collectibles are not capitalized, okay, as if they do not exist. But I'm sure the museum, they have a record of all the collectibles, but not in their accounting records. Assets, especially exhaustible assets, are depreciated over the remaining useful life in their government-wide statement. Again, government-wide statement, because we capitalize these assets, then we need to depreciate them. In government fund statement, right? Because they have been recorded expenditures already, so there's no need to depreciate. Non-exhaustible assets like land, work of art, or historical treasures, okay, are not depreciated. Right? Historical treasures. If we have a 200 years old building, right, it's not a building anymore. It becomes historical treasures, so it is not depreciated. Capital assets impairment is based on whether reduction is in service utility is both significant and unexpected. Remember FASB's rule, right? For financial accounting, FASB's rule is based on future cash flows. When the future cash flow is lower, right, then their carrying value, then we say it's the assets impaired. However, for non-profit or governmental, right, those assets are not used to earn future cash flows. So there's no future cash flow from those assets. Therefore, the only thing we can tell is reduction in service utility. If they're not as useful as before to serve the public, for example, then we say this asset is impaired. So here's a government-wide statement. The statement of net position, similar to a balance sheet. Let's see how City of Houston reported its capital assets. So if you look at this section, we have the capital assets. Okay, it's bottom of the assets column. Let's see what are those capital assets. We have land, right, and right away, buildings, equipment improvement, construction progress, railway rights, water rights, garage rights, intangibles, infrastructure assets, and we have a accumulated depreciation and amortization. The total will be subtracted from the assets column. And then we look at the actual presentation. We have two columns. We have governmental activities and a business type activities. For each government, both activities are available, but they need to be reported separately. We're going to talk about financial statement later in other lectures, but not here. Just give you an idea how we're going to report capital assets on the statement. Now if you compare the number or the amount with other assets, okay, then you can see the majority of assets in the City of Houston are capital assets. Also, we will find depreciation information. For example, remember for the previous one, this depreciation is accumulated depreciation and amortization. Right? Now we can check the depreciation expense, detailed depreciation expense for each type of assets right here. Right, if you add them together, we have a total depreciation expense, governmental activities, total depreciation expense, business type activities. Together, that is the current year's total depreciation expense. So back to the governmental fund. For example, let's check the general fund, look at its balance sheet. Right? Assets columns. We don't see any capital assets, and all these assets are current assets. All of them are current assets because government fund, our focus is current resources. There's no long-term assets. There's no long-term liabilities. So where do we find information? Okay? Because capital outlays, capital purchase will be recorded as expenditures. So in the statement of revenues, expenditures, and change in fund balances, similar to the income statement, the general fund, we will see your expenditure called a capital outlay. Okay, this amount, right, especially for capital project, these amounts are 2017's capital assets purchase. Okay, but we cannot find accumulated purchase, how much they have purchased in prior years. We don't have that number in government fund statement. We have to check the government-wide statement. Right, in this report, it's reconciliation. The statement of revenues, expenditures, changes in fund balance of the government fund to the state of activities, statement activities. This is for the government-wide. So basically, we're going to reconcile in this case, the expense and expenditures. They are different, basically. So for the capital assets could be the major difference, because in the statement activity for the government-wide statement, only expense related to capital assets will be the depreciation and net disposal of assets, right? These two. But for the expenditure on the government fund, right? Expenditure associated with increasing capital assets, new purchase expenditures. And so the difference between these two statements, it's $111,373,000. That's a difference between the expense and expenditures associated with capital assets in those two statements. As we can see in previous statement, not only the government activity is going to use capital assets, other business types are more likely to use capital assets. So we're going to see more capital assets in the business type activities right here. Right, for the business activities, we're going to see more capital assets. So what are those business activities? We also have the governmental fund for business activities, right? One of them is proprietary fund. It's a governmental fund that records business activities. For proprietary funds, we follow the full accrual basis. So we will see capital assets. Okay, we will see capital assets on its the statement of net position. Okay. Infrastructure. We go back to the previous slides. You can see infrastructure in Houston could be the biggest capital assets. Infrastructure assets. We understand, right? Infrastructure assets. We have the highways. So many, for example, highways, bridges, all these are infrastructure assets. Infrastructure is government's capital assets. Okay, they're immovable, stationary in nature, and they will be preserved for a longer period. So how to record infrastructure assets? GASB 34 requires that infrastructure be accounted in the same manner as capital assets. But there's an exception. they need not be depreciated if the government can demonstrate that they are being maintained or preserved at their specified condition level. In other words, if they're well maintained, okay, we just report a maintenance expenditure. Okay, there's no need a maintenance expense. There should be no depreciation expense because we do not depreciate infrastructure assets. To avoid recording depreciation, government must perform condition assessment at least every 3 years to evaluate condition of those highways, for example, bridges, and have an up-to-date inventory of eligible assets and estimate the amount to maintain and preserve the eligible assets. Okay, I think most government will do these to avoid recording depreciation, right? Basically just to make the financial statement look better. The depreciation of infrastructure assets will be huge expense. How to record infrastructure? We're going to record expenditures in the governmental fund, right? We may elect to adopt a modified approach for the government-wide statement for infrastructure. Let's see how we're going to record our infrastructure government-wide statement. All expenditures incurred to maintain and preserve those assets will be expensed. Additions and improvements will be capitalized. This is consistent with the financial accounting. Right? We need to assess conditions of the asset, and this will be disclosed. And also we need also report for at least 5 years the estimated cost of maintaining the asset at the specified conditions, okay, as compared to the amount actually expensed. So these are the accounting for infrastructure. Then let's talk about intangibles. GASB mandates that intangible assets be accorded accounting recognition. If what? If they're separable, if they arise from contractual or other legal rights. Okay, so these intangibles will be recorded. Intangible assets should be accounted for like other long-lived assets and amortized over their economic lives. So if we go back to those Houston right, we do see intangible assets, right? Marketable securities. So we'll move to investment part. Marketable securities. GASB 31. Basically, this is a rule for marketable securities. General investment. Governments either directly invest in stocks or bonds, or small governments may participate in investment pools maintained by other governments. So we do see a lot of investment by government. Derivatives. Governments typically engage in derivative transactions, not to speculate, but rather to reduce the overall investment risk. Derivatives could be a very useful tool to mitigate risk, basically reduce overall investment risk. but in reality, derivatives could be very risky by themselves. So let's see how we record our investment. All debt and equity securities are measured at fair value. Okay. Now compared to financial accounting, this is a very simple for investment. Remember how we're going to report investment in intermediate accounting? Right? We have to differentiate, right? Multiple levels. Security for sale, right? Held to maturities, and for trading purposes, right? And we also have to differentiate between equities and debt, right? So the rule is very simple here. All debt and equity securities are measured at fair value. Investment income, including change in fair value, will be reported in the operating statement or other statement of activities of all entities and the fund. Okay, so we recognize the basically so-called income, right, from the investment interest revenues, could be dividend revenues. And then we also have the gain in their fair values. All these will be recorded. There are exceptions. Exception for short-term securities. Governments are permitted to report money market investment having remaining maturity at time of purchase of 1 year or less at amortized cost. Amortized cost. This is just an opposite to the financial accounting, right? Financial accounting says, FASB says, okay, the debt securities held to maturities, long-term ones, will be recorded at amortized cost. Here, the short-term investment could be reported at amortized cost. Why? Because these investments typically include mainly certificates of deposit, commercial papers, U.S. Treasury obligations, right? Because of the short-term and they're very liquid, they believe that the fair value will not be very different from the amortized costs, because it's very close to the maturity date. And for derivative instruments, okay, the rule is a little bit different. For derivative instrument, especially those that represent effective hedges against other assets and liability, okay, the gains and losses will be deferred and reported on balance sheets as deferred inflows or outflows. If they're used as a hedge against other assets or liability, then if we have any gains and losses, okay, they're not going to factor be a revenue or expenditures, rather they're deferred. They're deferred, okay? Deferred inflows or deferred outflows. Disclosure requirements. Government should organize disclosures by investment type, right? Also disclose their vulnerability to specific type of risks. So I'm going to discuss these risks. Custodial credit risks, right? The securities are uninsured and collateralized, not in the name of the government itself or not in the physical position of the government. So see, this is known as custodian credit risk. We also have credit risk right? The issuer of an investment will not fulfill its obligations. In this case, we may lose money, right? If the issuer do not, for example, cash the pay the bond, then we're going to lose money if we hold those bonds. Right? And we also have interest rate risk. The change in market interest will adversely affect fair value of the investment. And finally, foreign currency risk. Fluctuation exchange rate also is going to affect our investment. These four types of risks will be discussed. All right. So let's move to obligation, liability, long-term liability. General long-term obligations are issued by almost every government, right? Which take the form of liabilities, usually bonds. And the bonds are usually secured by the full face and the credit of the government, of the municipal government, of the state government, or the federal government, right? Only the long-term obligations arising from the government funds activities can be called the general long-term obligations, right? Any other long-term obligations from the, for example, proprietary or fiduciary funds cannot be called general long-term obligation. They're not general. What are those general long-term obligations? We have tax-supported bonds, long-term warrants, long-term notes, capital lease obligations. All these are general long-term obligations. Accounting for a general long-term obligation. For a government-wide statement, right? Or general long-term debt is reported in the governmental activities columns of the government-wide statement of net assets. We have seen that already. So we do report long-term liabilities, right? The statement of net assets. And the general long-term obligations are recorded either at face value or at the amortized issue price. Right? Bond is reported at amortized cost. I'm going to see examples later. Actually, we have seen similar examples in fast-paced financial accounting, right? It's the same thing. It will be reported at amortized issue price. Basically, it's the price plus premium, right? Less the amortization, or price less the discount, less the plus amortization, basically. In government fund statement, we do not report long-term liabilities, right? But we do record long-term liabilities in the schedule of long-term debt, okay, which is supplementary disclosures. How we do report them in the schedule of long-term debt. We call that debt service fund. It's generally established to account for the principal and investment payments on general long-term debt. And we have seen this in the previous lecture, right? How we use the debt service fund to pay for the principal and the interest, right? Bonds. So we may have term bond or zero bond. We discussed about a difference in previous lectures. And also have demand bond, also known as a put bonds. obligation that permits a holder, right, which is the lender, right, to demand redemption within a specified period of time. Yes, usually if we have a demand bond because the lender or bondholders can ask money, right, at any time at their will. So we really don't know when they will ask redemption. So at any moment we're going to keep those demand bonds or put bonds at short-term obligations. Right? Have to be prepared because at any time they may ask for redemptions. But there's some exceptions. Demand bond could be reported as long-term liabilities if the government, right, enters into a contract called a takeout agreement with a financial institution. The lender promises to lend the issuer sufficient fund to repay the bonds, and the contract satisfies the following criteria: does not expire within 1 year, is not cancelable by the lender during that year, is capable of being financially satisfied by the lender. Okay? In short, demand bonds are usually reported as short-term obligations, but they may be reported as long-term obligations if the government has a contract with a financial company. So if the bondholders asking for redemption, then we can go to the lender, different lender, we're going to borrow money from them and to pay for the bond. Right? In this case, if we have the contract existing, which satisfies other criteria right here, we may still report them as long-term obligation, not as short-term obligation. Remember them, it will be reported as long-term obligations. In addition to bond, we also have notes. It's also borrowing. We have bond anticipation notes, BAN, bond anticipation notes. So these are short-term notes issued with the expectation that it will be replaced with long-term bonds. So we're going to start a project, right? We're going to issue bond to fund that project, but kind of too late. So we want to start early. In this case, we can issue bond anticipation notes. Okay? So investors are willing to lend money because they know we're going to issue bond pretty soon. Then we have the money to pay for this note. So usually their BANs are short-term liabilities. But right, the accounting rule says the BAN may be recognized as long-term obligation if what? If BANs are refinanced and the entity enters into an agreement that doesn't expire in 1 year, has not been violated, and is capable of being honored by the lender. The same thing. These short-term obligations, if they're refinanced or they are about to be refinanced, or they have the ability to refinance, then we can report BANs as long-term obligation. We also have revenue anticipation notes and tax anticipation notes. The idea will be very similar to BANs. But they're different from BAN in that they are short-term debt. Okay, and are not converted into long-term instruments. So only the BNN can be reported as long-term obligations. The RANs and TNs can only be reported as short-term obligation or short-term debt. Lease. Lease is a contract that conveys control of the rights to use another entity's non-financial assets as specified in the contract for a period of time in exchange or exchange-like transactions. But basically we understand what is a lease, right? This is just a formal definition. Lease term. Lease term is important because it's going to for accounting is based on lease term. The Gatsby 87 specified that lease term is the period during which the lessee has a non-cancelable right to use the assets plus any periods for which it is reasonably certain the lease will be extended or terminated, given the options available to either the lessee or lessor to extend or terminate lease. Right? In one example is I can sign a contract with for example, a dealer, right? Or the 1 year vehicle lease contract. But this is look like a very short-term lease, right? It's a 1 year. But in the contract, I have the option. Every year I have the option to extend. Okay? And the dealer cannot terminate it. They cannot say no, but I can say no. So I have the right to either to extend or terminate contract. But it looks like there's no reason for me to terminate contract soon. So this lease will be, what's the term of the lease? Well, it's no longer 1 year term. Right? It should be multiple year term, long-term lease, because of this option to extend. Alright, so let's see how short-term lease is recorded. Short-term lease has a maximum possible lease term of 12 months or less. Okay, short-term lease is accounted for as operating lease. Okay, a journal entry when lease payment made is very straightforward for operating lease. Debit lease expenditures or lease expense and credit cash. Okay, so the journal entry for the governmental fund and the government-wide statement are the same, except we use a different term, one expenditures, one expense. But the journal entry will be the same for operating lease, which are usually short-term lease. Now, we also have long-term lease, right? And how do we record long-term lease? Then in the governmental fund, right, long-term lease will be reported as expenditures with debit expenditure, and we credit other financing source. Long-term lease. Right, so we ignored both the leased assets and the lease obligation, right, in the government fund because they are long-term assets and long-term liabilities. When we pay, we debit expenditures, lease principals, also debit expenditures, lease interest, and credit cash. This is for the governmental fund. And for government-wide, or for the proprietary funds or fiduciary funds, all these are for full accrue basis. Right? When we sign the lease term, when we sign the lease, we will debit assets held in lease, which is long-term assets, and the credit, right? Lease payables, long-term liabilities. So we recognize both long-term assets and long-term liabilities. Right? This asset held in lease typically is viewed as intangible assets. When we pay the lease, we debit lease payables, right? Interest expense, and credit cash. Why we have lease payables? Right? Because the lease has been, the liability has been recognized already. Okay? Right here. So this could be viewed as the principal, right? This is the interest, just very similar to this one. In addition to these transactions, we will need to amortize these assets held in lease. Amortize assets held in lease. So let's see this example. A municipality signs a 3-year lease for construction equipment, agreeing to make annual payments $200,000 based on an interest rate of 4% that is implicit in the agreement. The present value of liability is $555,018. So this is the present value of the annuity, right? The $200,000 for 3 years, discounted at 4%. And we have seen this. Should be able to calculate this, right? We have taken the intermediate accounting. So government-wide, for sure this is a long-term lease, right? So the government-wide, we're going to debit the equipment held under lease, which is present value, and then credit lease liabilities. Then we make the first payment. We credit cash for sure. Okay, then we're going to debit interest expense. Interest expense is calculated based on outstanding liabilities and the interest rate, which is 4%. Okay, so we debit interest expense, then the rest will be a reduction in lease liabilities. Okay, the next period when we pay $200,000, our interest expense will be reduced because their outstanding liability is smaller, right? Additionally, we need to amortize this equipment held under lease. We debit amortization of equipment held in lease. If we use a straight line method to amortize, then we're going to credit equipment held in lease. So by the end of the 3rd year, this equipment held in lease will be fully amortized, will be totally gone, and this lease liabilities will also be paid off by the end of the 3rd year. For a governmental fund, that's a little bit different, right? We only debit asset expenditures and credit other financing source, long-term lease, right? Without recognizing the asset and the liability. And when we make the first payment, this will be the same. The debt service expenditure interest is calculated as the 4% multiplied by their liability outstanding. and the rest will be reported as debt service expenditure, lease principal. Other topics. Revenue bonds. Revenue bonds are backed only by specific revenue streams. Generally, they are reported enterprise funds. They're used by enterprise funds. But the main reason for issuing revenue as opposed to general government bond are, what's the benefit? They provide a better match of debt service cost and the benefits received. They better match the debt service cost and benefit received, and although the risk is a little bit higher than general obligation bond, but overall the risk of the entity's debt is so, therefore its total interest will be insignificant, unlikely to increase over risk, basically. But the true reason, what's the true reason to have those revenue bonds, is in many jurisdictions they're used to avoid voter approval, okay, and other debt limitations. So the general obligation bond is very strict, okay, subject to voters' approval. But for those revenue bonds, many times they are not subject to voter approval. Okay. And also because usually we're going to issue those revenue bonds in enterprise funds. We know that's business activities, right? So we don't have to obey their debt limitations in government fund. Usually the government fund is well budgeted, okay? The amount of revenues and the amount of expenditures will be budgeted. So, and there's also a limit in total amount of debt we can get, right? So if we can give that to the enterprise fund and let them to issue revenue bonds, maybe they can transfer the money back, or they can directly contribute to the project or to the service, and we can avoid avoid the debt limitations easily. Debt margin. This is also known as debt limit. Usually it's a ceiling on the amount of debt. This is the maximum amount of gross or net debt that is legally permitted. We call this debt limit. The debt margin is the difference between the debt limit and the net amount of debt outstanding, subject to the limit. So we have the limit, which is ceiling, and we have the current amount. The difference between the ceiling and the current amount is called a debt margin. This is a possible debt we may incur, okay, possible money we may borrow, debt margin. For example, the city is permitted to issue maximum 30 million of general obligation bond. It already issued 19 million of qualifying debt outstanding. So what would be the city's margin after issuing 8 million of new debt subject to the limit? So the city has already have 19. City has already have 19 plus 8. That is outstanding will be 27, right? The 27 less 30, so the debt margin will be 3 million, okay, which is 10% of 30 million. 10% of 30 million, the debt margin. Okay, incur additional 3 million debt, and we're gonna reach the ceiling. Overlapping debt. overlapping debt. So what is overlapping debt? To understand overlapping debt, we need to understand direct debt first. Right? Direct debt is the debt that a government unit has incurred in its own name or assumed through the annexation of territory or consolidation with another government unit. An obligation will be repaid by the government whose debt is being evaluated. Okay? In simple words, these are the debt that I borrow, right? I use. That's a direct debt. I borrow, I pay, right? I pay for it. But we also have overlapping or indirect debt. These are obligations of other governments, okay, that also have the power to tax property located in the jurisdiction of the government whose debt is being evaluated. So what is overlapping? So we know many times we're going to have overlapping between city, county, school district. For example, the school district usually will be a little bit larger, right, than the city. Let's see. Let's look at this example. A city served by independent school district that includes the city as well as nearby towns. So the independent school district is larger. The assessed value of taxable property within the city is $600 million. And for the school district, it's a bit larger, $800 million. So the city is inside, it's part of the school district. Now, the school district has $48 million of debt outstanding. So you can think the other way. The people living in the school district, they have to pay $48 million. That's a debt on them. But we know these people also, part of them also live in the city. So we calculate that 75% of them, okay, are living in the city. So these people are also paying the debt for the school district, but when the city was considered levying taxes on them, the city has to consider, right, the debt, which is 75% of the school district debt, which is $36 million. The city has to consider $36 million when they are about to levy tax or issue new debt, because they know the people in their jurisdiction has already, right? They already have the burden of $36 million debt. And this is the indirect ones, overlapping debt. Right? The city is not going to, that the city didn't borrow it. The city does not have to repay it, but the city has to consider the debt, because eventually the people who's living there is going to pay for it, right? So a government cannot report the overlapping debt on its own statement, because it's not its own debt. A government should include a schedule of direct and overlapping debt as a supplementary information in the statistical section of its annual report, right? Because it's important for people to understand the debt conditions, including the direct debt and overlapping debt. Conduit debt. These are obligations issued in the name of a government on behalf of a non-government entities. Usually these are the government try to help, right? Try to help a non-government entity to get a loan, basically, or to get money, to get a borrowing, basically. So conduit debt is also known as non-commitment debt. In case of default, bondholders have claim only to the property and the lease payment. Okay, because the government are not responsible to pay back to pay for it in the form of governmental assistance to beneficiary organization, right? So it's a kind of assistance. And also these debt, okay, these bond or interest or tax exempt, so becomes very attractive to investors, right? They don't have to pay tax on the interest earned. So usually we can issue those bonds at really low interest rate. So the GASB says we need to disclose, right? Disclose conduit debt, and that's it. But if they're not the government's own debt, they just help. They just help the other people to get a low rate. Moral obligation debt. Bonds, notes issued by one entities, for example, the state agent, but backed by the promise of another entities, like the state itself. This is known as moral obligation debt. Okay. So basically, it is motivated to avoid voter approval or to circumvent debt limitations. When there's a default, right? This kind of promise, for example, from the state, is not enforceable. Okay, it's not enforceable. Right? Bondholders cannot ask money back from the state. They have to go to the state agent who borrowed money. Okay, and for the state itself, it's just there's a moral obligation, which is not enforceable. So many times it just this is used basically to avoid a voter approval, right? Who's borrowing money in this case? Very likely the state. The state is borrowing money, but because there's a voter approval or other limitation, the state is going to ask the agent, right, to borrow, but backed by the promise from the state. So this is called a moral obligation debt. For sure, these moral obligation debt obviously are not secure, right? Not as secure as the state general obligation bond or general obligation debt. So investors understand the risks, so usually the interest rate will be much higher, much higher. Right, this is pretty much for this lecture.